Hello and welcome to this Thursday's morning market briefing. We've got lots to talk about, but firstly, the Federal Reserve keeps interest rates at 22-year high, but hints at cuts to come, as well as that the UK economy shrinks unexpectedly in October. We've got lots to talk about in the charts. Also, with lots happening on the economic calendar, we'll come to that near the end, so make sure you stay around so you see that. But before we get straight into it, make sure to subscribe. But the first article to talk about, of course, is the Fed. Now, the Fed held rates at 22-year high in yesterday's meeting, with forecasts now predicting the Fed to implement 0.75 percentage rate points of cuts next year. Now that's very significant, of course, as yesterday we were basically predicting what may happen in this meeting. And whilst we did expect interest rates to stay at their current levels, as they now have done, we were more so predicting and looking out for what the rhetoric may be in the next meeting. And that's the meeting which took place yesterday, of course. Now, in yesterday's meeting, we did hear some very interesting rhetoric, and that's greatly affected the markets, which of course we'll come to near the end. But ultimately, projections were also made by the Federal Reserve in relation to how the economy will be doing next year as well. Now, the projections have a greater scope for the Fed to cut rates than previously projected, with rates expected to sit at 4.5% to 4.75% by the end of next year, with rates even lower than that. With rates even lower in 2025, where officials are forecasting rates to end up between 3.5% to 3.75%. So significant rate cuts are expected for next year, most definitely, and rates are expected to go even further lower in 2025. But I think what's also interesting to note from that kind of prediction and projections by the Fed and other officials is the fact that rates are expected to stay around that 3.5% level in 2025. Like coming to the end of 2025, that's where rates are expected to be. Now that's quite some time away, and that's quite some time for rates to still be at significant levels. We're kind of emerging out of this cheap money era, as many people have noted, and the kind of effects of this, I guess, have still not been felt to a great extent, which is why we're now seeing slowdowns and that sort of thing as a result of the higher interest rates. But what will be interesting to see is, how does the economy cope in a year, let's say, or in 2 years, when all elements of the market, even factors of production or processes within the production method, which may not be as vulnerable to interest rate cuts or rises, how will they then be affected by this newer higher interest rate era, which a 3.5% interest rate would kind of create. So I think that's something to note as well and take interest in. Now, the statement following the decision showed softer language around rate hikes, and that's what we were mainly talking about and focusing on as the key element in relation to this interest rate decision is the rhetoric, and it does seem to be some more dovish rhetoric. And as a result of this more dovish rhetoric, US bond yields and stocks ticked higher, with the US bonds and stocks ticking higher, with the US 2-year yield falling 0.18% and the 10-year yield falling 0.13%, all the way down to 4.07% yield. Now it's its lowest level since September the 1st, so a significant fall in the yield there for US bonds. Now, stocks also ticked higher, with the S&P 500 rising 0.5%, so a significant rise on the S&P 500. Now, we'll come to the stocks near the end, so make sure you stay around till you see that, as we will be looking at all of those US indices and breaking down where price may be and may be going. Now, this latest decision continues the Fed's effort to bring inflation back down to that 2% target level. As we do know, this is the common kind of target inflation level for the ECB, Bank of England and Federal Reserve. Therefore, they're all kind of striving for this 2% level. Some are closer to it than others. As we know, the ECB is far closer than the Bank of England, for example. But ultimately, they're all trying to hit this 2% mark. And, as inflation has been coming in under expectations throughout the past 3 months, let's say, traders have been pricing in, rate cuts sooner than previously expected, as that kind of target rate was expected to be hit earlier than previously expected. But interestingly enough, today's kind of yesterday's and this week's kind of economic data in relation to the US, of course, has been signaling something different, with officials having pledged to move carefully with any policy decisions. And that's what we were kind of hearing throughout the period where we were seeing inflation actually come in below expectations. We were hearing repeatedly from the Fed that they were going to take it slow with any policy decisions and really wait for a great deal of data before making any large decisions, with previously traders believing the Fed would start cutting rates in March of 2024. However, recent inflation and jobs data has moved expectations to a May rate cut. Economic projections by the Fed barely changed from September. However, expectations for core inflation dropped from 2.6% in 2024 to 2.4% and 2.2% in 2025. That's quite interesting to note, of course, considering that, following the kind of 2 months of lower than expected inflation data, we did, 2 days ago now, have that data release in relation to US inflation, which did present US inflation above expectations for core inflation. And as we know, core inflation is the inflation kind of figure which is most tracked, as it does exclude those more volatile kind of items such as fuel or food, and therefore it's better for the Fed to kind of track that. That's all to talk about in this article, though. Of course, we're coming to the articles near the charts near the end to cover maybe what's happening in the markets as a result of this decision a bit more. But next article to talk about is the UK economy shrinks unexpectedly in October. Now, the UK economy contracted in October, with 3 main sectors reporting declines in output. Now, these figures point to a weakening economy just ahead of the Bank of England's final interest rate decision of the year. And of course, this is what we spoke about at the start of the week, but that interest rate decision is taking place today. So what will be interesting to see is how maybe this GDP figure will affect the Bank of England's rhetoric, because despite any figures really that we might receive in the lead up to the Bank of England's decision, most likely rates are going to stay where they are. It seems that that's the consensus. So what will be interesting to see is whether this figure plays into Andrew Bailey's speech today, and whether that changes the overall Bank of England's outlook. Now, GDP fell 0.3% between September and October due to declining services, manufacturing and construction output, which is contrary to an expectation of no change in GDP. So, the UK did come in under expectations in terms of GDP growth, but at the same time, this could benefit the Bank of England as a whole. So, we always kind of have these, give and takes with the economy and how we manage it. Because obviously, if we're kind of looking to lower inflation, that's the key goal at the moment, then we're likely to see those contractions within the economy, or at least slowdowns, as a result of, the interest rates, harming consumer demand, and as a result, and also, producing goods, will obviously cost more money with higher borrowing costs, and therefore, we expect these shrinks. But obviously, this is in the process of trying to get lower levels of inflation. Now, these figures come just a day after labour market figures showed slower wage growth. Whilst the Bank of England is expected to hold rates still, the rhetoric will obviously be most important in today's decision. So that's the key thing that we need to listen out for. Now, following these figures, the pound weakened 0.3% against the dollar, as bets were made that the Bank of England would be forced into deeper rate cuts next year. As obviously, if we are seeing contractions within the economy, despite the Bank of England wanting to lower inflation, we are more likely to see those rate cuts sooner than previously expected, or at a greater level than previously expected. Now, markets are now pricing in 4 rate cuts over 2024, with rates eventually reaching 4.25% by the end of the next year. And obviously that would be lower than the rates expected for the Fed to reach next year. So I think that's interesting to note as well when we're looking at how the dollar and the pound may move against one another. Now, bonds strengthened following the data, with yields falling 0.05% to 3.9%, with this new data also reigniting speculation over whether my bad about with this also kind of reaffirming those speculations which were happening over whether the UK economy would shrink and move into recession. As obviously, if we are seeing contractions with an economy, it only takes a few of those contractions to then create a recession for the economy, which would obviously reflect badly on not only the government but also possibly even harm the citizens of the nation. Now, the GDP figures were dragged lower in partly by wet weather, but is still a disappointing figure nonetheless, with wet weather negatively affecting activity in retail, pubs and tourism, with I believe the actual figures of rainfall and how wet it was within the UK in October being the greatest for quite some time. Therefore, adding to this kind of understanding of why we did see that recession, or at least contraction, not recession. Now, the fall in services output being 0.2% and being the main contributor to the decline. So it does seem that the services industry did bring down the figure overall, with the UK economy in October being no bigger than at the start of the year and smaller than in spring of 2022 as a result of higher prices and interest rates. Of course, we do know those have great effects on the economies in which they deal with. Now, this latest GDP figure could also force the Bank of England to walk back previous growth forecasts. So definitely keep your eyes on this, as we do have the Bank of England's interest rate decision today. So it'd be interesting to see how this does affect that. So listen out for that figure. We'll come to that again on the economic calendar near the end, so make sure you wait around till you see that. But that's all to talk about in this article. Next thing to talk about, of course, is the charts, where we must start off with the US indices and the US 30, considering the Fed's interest rate decision today, which has greatly affected markets. So as we did note on the articles, the Fed did present a more dovish picture during that speech and the press conference which obviously followed. And from that, we have now seen US indices take a strong bullish move to the upside, and as we can see here, the US 30 is continuing to move in a bullish manner. Now, obviously, US 30 has been on the move to the upside since the start of November. However, it has stalled out a few times, consolidating or at least moving in a slow bullish momentum to the upside, and we did see that repeated last week. Interestingly enough, though, going into the start of this week, we did find the bullish momentum to the upside for the US 30 in particular here to take a significant move to the upside, as we're seeing. And following the Fed's more dovish rhetoric, we are seeing this bullish move continue. So what will be interesting to see is how far US indices can really go, as the US 30 has now made new highs, I do believe. It has now broken above this most previous, the most, well, not even most recent, but, the previous high, sorry, I'm trying to get it up here, for the US 30. And as you can see here, if we just map that out, you can see here that we've just broken above that previous high level. What will be interesting to see, though, I think, is on the daily chart, if we can then see price come back round and retrace and reconnect with that most recent high. The highest level the US 30 has ever seen, as that will be very interesting to see, as it will act as a strong area of liquidity and buying support. So keep your eyes on US30. Next to talk about though is the dollar, which on the other hand has seen a great sell-off following the Fed's interest rate decision. Now we had seen this kind of counter trend line form on the dollar over the past few weeks, since the start of December really, but price was continually coming into contact and resistance with this strong area of liquidity around the 104.2 level. Now price had continually come into contact with that, finding that a strong area of resistance, but obviously following the Fed's interest rate decision, we have seen a significant sell-off, breaking that counter trend line and seemingly continuing this sell side momentum that we have seen for quite some time now on the dollar. Now that said, price has now just come into contact with the 78.60. That said as well, is the trading kind of principles going to hold up in the face of such strong fundamental movements? That could be something that's debated, and I would see that as quite a doubtful. I would quite doubt that. So ultimately, we are most likely going to see now a continuation to the downside, but of course, keep your eyes on that. Next talk about though is Euro USD. So still on the topic of the dollar, but interestingly enough, from that level, which I did note, I think at the end of last week, where price I knew would come down to and would likely serve as a significant area of buy side liquidity, we have now seen a significant move away from that area which we were looking for. And just as we did predict, this Fed's interest rate decision has acted as the significant level of momentum for price to move to the upside, as we've seen here, with price now significantly moving away from that area of liquidity. What will be interesting to see though is, because we do have the ECB's interest rate decision today, as well as the Bank of England's, how these interest rate decisions may then affect Euro USD. Of course, the ECB's interest rate decision and rhetoric will be far more important than Bank of England, but having that competitive kind of nature, it will still be interesting to see how that works out. So keep your eyes on Euro USD with today's ECB interest rate decision. Next talk about though is pound yen, which going into the Bank of England's interest rate decision today, but following that GDP figure yesterday, we have seen a sell off on the pound yen, and that's following a significant sell off not too long ago after the yen shot up following increased expectations that the yen would see that kind of bullish support following a Bank of Japan interest rate rise. So we now have seen this continuation of a sell-off to the downside after price did come into contact with that 50% Fibonacci level, but definitely keep your eyes on pound yen as we do go into this interest rate decision today with the Bank of England. Next to talk about though is USD JPY, where we also have seen that sell-off, and we've seen this continuation of this sell-off from this area of liquidity that we've noted, but it'll be interesting to see how far now USD JPY can continue to the downside, as we now do have that significant sell side momentum built by the Fed's rhetoric yesterday, and we also have that increased speculation for the yen, which is providing the yen that bullish momentum. So keep your eyes on USD yen. Next to talk about though is Bitcoin, which does move higher after coming into contact with this 50% Fibonacci level. Now we were kind of speculating and wondering where price may go, as it had come into contact with that 50% Fibonacci level. However, it had kind of stagnated and not made a significant move to the upside or downside, but it does seem now that the Fed's interest rate decision yesterday and their rhetoric around that has provided Bitcoin with a significant amount of bullish momentum. And this is what we noted and predicted was, surprisingly, the Fed's kind of rhetoric does have a great impact on Bitcoin, and therefore we do need to keep our eyes on, anything Fed related if we're looking at Bitcoin as well. So keep your eyes on this as we do come into contact with now this significant area of liquidity and resistance on the charts. Next to talk about though is gold, which does shoot higher following the Fed's kind of more dovish rhetoric yesterday. And this is obviously influenced by the fact that gold is a safe haven asset. It does, allow investors to move their money into something that's more protected against inflation in comparison to, maybe the dollar, which is now reportedly going to have interest rate cuts next year to a greater extent than previously expected. And this is why we're now seeing gold make a significant move to the upside after coming into contact with that 78.60. What will be interesting to see, though, is how far gold can now go. That's all to talk about in the charts, though. Lastly, to talk about, of course, is the economic calendar, where we do have a significant amount of data coming out today. Now, firstly, we will have Aussie unemployment data, as well as their, manufacturing and services data being released. So listen out for that. As well as that, we're getting the Japanese industrial production figure released, along with the Swiss interest rate decision. And most importantly, I believe we will be getting the Bank of England's interest rate decision, as well as the ECB's interest rate decision and their press conference, which obviously does follow. So listen out for those two interest rate decisions. Obviously, we're expecting both rates to stay the same. It's really the rhetoric from, Andrew Bailey for the Bank of England and President Lagarde for, their rhetoric to understand where, interest rates may go in the future, and therefore how that will affect inflation and prices within the nations or regions, as well as that, we are getting US retail sales data, which is being released, along with US business inventories data. So lots of data coming out this week. Listen out for all of that to make sure, not this week, sorry, lots of data coming up today. So listen out for all of that to be well prepared. And yeah, have a great trading day. But that's all from us at Wildwood Capital. We've covered a lot. See you later. Bye.